Hello and welcome to the Investing on the Go podcast. I'm Chris Sarley and today we're joined by Job Curtis, manager of the elite rated City of London Investment Trust. Thank you for joining us today.
Good morning, thank you.
The trust has the best track record of any investment trust for dividend increases, having raised its dividend for 54 consecutive years now. And it's been able to achieve this by dipping into its revenue reserves on occasions when income has really been hard to come by. Obviously, this year, 2020 is a prime example as UK dividends have sort of been slashed sort of indiscriminately across the board due to lockdown and sort of unforeseen circumstances. I guess the first place to start is, could you talk us through how the companies you hold have held up, and maybe how much of the revenue reserve you've used this year and how much you still have left given the challenges that are ahead?
Yes, this has been a very difficult year for dividends, and almost half of FTSE 100 companies have a cut or past their dividends during the course of the year. The core of our portfolio was very solid. Our biggest sort of group is consumer staples. These are the makers of everyday products. And in fact, the three biggest holdings in the fund are BAT, Diageo and Unilever. And that's been a very solid area for dividends. Some 22% of our portfolio includes supermarket groups like Tesco and Morrison in that category. Then, we have 9% in pharmaceuticals, again, very solid, and other areas have been defensive like utilities and telecommunications, the overseas stocks we hold there. So, but having said that, we have been affected inevitably in two areas, particular weakness for the banks, where they're banned from paying dividends, and we've had to reduce them, and because they're much better condition they were in the financial crisis, but they are leveraged institution sensitive economic activity, and also travel and leisure, where we took a view this area would be very hard hit and slow to recover because of social distancing. So we did reduce in those areas. So in all, we took about 14 million from our revenue reserves. So it did help. We've been putting into revenue reserves for the last 6 or 7 years. And so, they're there for a rainy day. And if ever was a rainy day for dividends, this was it. But we still, having taken 14 million out, we still got around 46 million, 45 million in revenue reserves. So, and we do model different scenarios of dividends, and we have 3 main scenarios. And even on the most pessimistic, our revenue reserves would be sufficient for the next 4 years. So, we think we are, and we've used the advantage of investment trust to use those revenue reserves to increase our dividend by 2%, as well as the dividends we receive from the core of our companies, which have been very strong.
You mentioned there the 3 base scenarios. Could you maybe talk us through your outlook for dividends for next year, and which scenario you think is perhaps most likely of the 3, and maybe talk us through some of the companies that have perhaps started reinstating dividends, or have they, and maybe just talk us a bit through the outlook for that as well.
Yeah, I think it's been a huge reset with a lot of dividend cuts across the market, and some companies, the outlook was so unclear, in April, March, May, that there were some companies who could perfectly easily have paid a dividend and didn't pay a dividend at that point. So we actually have seen in the autumn, in the half year reports, these companies, quite a few dividends coming back from the portfolio. Examples in our portfolio would be BAE Systems, the big defence contractor, Direct Line Insurance Group, Ferguson, which is a very big builders merchants in America. And these are all companies that really, out of an abundance of caution, didn't pay dividends back in April, May, and they've not just paid their interim dividend, also kind of paid us the dividend that we were owed back in that period. So I think there's been a large reset. I'm pretty confident most of the big companies that were going to cut their dividend have done so. So it's kind of more of a question of going forward. To what extent do dividends just flat line and do nothing from here, or do we make a modest recovery? Do we make quite a good recovery? So far, the signs have been quite good. We've actually had quite a good recovery over the last couple of months, with companies coming back to the dividend list. And only time will tell, and obviously a lot depends on how the economy recovers. But overall, I'm very confident we've seen the worst of it, and certainly the short-term indications are that we're beginning to enjoy quite a nice recovery in dividends.
I wanted to perhaps look at a couple of sectors in a bit more detail. So perhaps could we talk about oil and tobacco? You've been quoted recently as saying that the oil industry is in a state of managed decline, much like tobacco's been over the past decade or so. Obviously, you still hold both of them in your portfolio. So maybe tell us, is it possible to make money from these industries that are in decline? And if so, how?
Yes, it certainly is possible. And the tobacco sector over the years has been a very good sector for dividends and profits, despite being a declining industry. I still feel this tobacco sector, I mean, we haven't got a huge position, but we do have, we are overweight BAT and Imperial brands, and we've about 7% of the portfolio in tobacco. And this is a very good area for dividends and helps underpin our dividend commitment. And they've been very good at managing decline, the leading companies in that sector. I mean, oil and gas, I think the issue is this transition to a kind of greener economy with more electricity. And, in the long run, it probably does mean a decline in demand for oil and gas. But I think it's going to be quite a slow process. We're very dependent on oil. And it's a question of how well the companies manage it. If they can, spend their capital expenditure more efficiently and target it in a more efficient way, then that could be quite positive for investor returns. I mean, it's a huge area. We are actually underweight compared to the index in oil and gas. So we've got less than the market averages in both Shell and BP, who both cut their dividends. But they're probably cut back to a level which they can really afford now. They were probably too high previously. So I'm not inclined to sell out of it at these levels. And I'm hoping it's still an unknown how they do manage transition. Both companies talked about investing more in renewables, and there's a lot of uncertainty about what kind of returns they can achieve in that. So, we're underweight, but we do have some exposure in oil and gas through Shell and BP.
And maybe could you touch upon what your outlook is for the UK generally at the moment? I mean, obviously there's another Brexit deadline looming, and we've had the sort of the Damocles of Brexit hanging over the economy for a number of years now. We've also got a number of local lockdowns, and the government's also starting to replace some of its schemes with, generous schemes, shall we say, with less generous ones. I mean, does that worry you? Does that impact you? How are you approaching that?
Yeah, I mean, the Brexit is a difficult one. It's just so hard to read with, the rhetoric from, both sides, and obviously the people laying down their kind of negotiation position, what the real true position is. But it's certainly, you'd have thought it's in both the interests of the UK and the EU to have a deal. It's got, both sides would benefit from a deal. So one is hopeful that, one will be reached. I think in terms of the economy, we've had a unprecedented lockdown in Q2, so GDP fell by 20%. And then as the economy reopened, we've had a very big bounce in economic activity. Some of these government schemes are rolling off or changing. We've obviously had unprecedented fiscal and monetary stimulus from both the government and the Bank of England to help the economy through, obviously had been locked down because of the virus. But I think the UK economy has shown quite a lot of flexibility over the years. This is a really tough one being thrown at it, but it's, other countries have got the same. And obviously we need to adapt to new circumstances. But I'm pretty confident overall. I think the government's going to be very keen to avoid another national lockdown and go more the route of local lockdowns, because they've got to weigh up both the virus and the dangers of the virus, but also the other health risks and the state of the economy generally. So I think we've seen the worst of it, but it's obviously very uncertain. And in terms of a vaccine, our experts within our company are confident the vaccine will come on the market probably early next year. But so not quite as soon as some people expect. But apparently their view is the trials are very promising in terms of vaccine.
And just finally, international sort of investors have seemed to be shunning UK equities, and even Brits seem to be shunning the home market. I mean, the data on outflows is sort of quite sort of depressing, really. What would you say to sort of convince people that UK PLC is still open for business and there are still strong companies to sort of take opportunities within the UK?
Yeah, the UK has been very out of favour. I mean, Brexit may play some part of it, but I think more recently is the fact that one of our great virtues has been our dividend track record in the UK, and we've had so many dividend cuts we were discussing earlier. But so I think the extent to which investors can get a feeling that actually we turn the corner on dividends, I think that could attract money, particularly people looking for income, back into the market. There's no question the UK is looking very cheap relative to other markets. And, if the news is not quite so bad as people are fearing, and, whether it's Brexit or the virus or growth generally, that things go slightly better than people are fearing, then I think, the UK's set up for quite a strong bounce. That's my personal opinion.
Okay, that's great, Joe. Thank you very much for joining us today.
Thank you.
And if you'd like to learn more about the City of London Investment Trust, please visit FundCalibre.com. And while you're there, remember to subscribe to the Investing on the Go podcast. Please remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these stocks at your time of listening.